How are you doing, everybody? Another video, and today we have a new partner join Trader Pool. Like always, as you know, if you are a member and a trader of Trader Pool, we are always looking to provide you with the best tools in the market. So just to give you another edge, so today with me, Thomas. How are you doing? Great to
Very
have
good.
you here.
Thank you very much. How are you?
I'm wonderful. So, Thomas, let's dive right to it. And we're talking about obviously giving our traders all the time a new tool that can help them to either find a great support and resistance level, or scanners that will show them the right asset to trade on any given day. And as you know, as obviously the guys that have been trading with us now, we're always looking to improve them and give them the opportunity to actually increase the chances for them to pass the evaluation and become a funded trader. So how is Stock Traders Daily actually will help them to do so?
Well, we're specialists in technical analysis. We're rooted in that principle, and we began back at the peak of the internet bubble. So we fell into this. We developed rules-based trading strategies, and over time have developed algorithms and AI that produce optimal entry and exit levels for our clients. And some of the biggest institutional investors in the world now read us, and they use us for our market analysis, our entry and exit levels based on S&P 500 and NASDAQ 100 and the associated index ETFs. But it's rooted in the proactive discipline that traders need to be successful.
Right. So take me through it just a little bit more. You're saying it's a market analysis, right? You get levels, intraday levels, or are we talking about intraday or like swing levels?
Intraday levels and swing levels as well. But I think for proactive traders, the intraday levels are much more actionable. Plus, you get to control risk significantly when you do so intraday, and overnight risk is sometimes questionable, right? I'll give you an example. The simple rules of technical analysis suggest that we buy near support levels,
right? We
stop if support levels break, and then we look for a directional move from that pivot point to make our next trade one direction or the other, right? The key here, though, is to find that appropriate pivot point. Well, at Stock Traders Daily, we're giving you those appropriate pivot points. That's what our algorithms do. That's what our AI does. That's why the institutional investors read us, because our efficiency, it helps them increase their efficiency significantly, because now they just need to execute the plan. They don't need to go to work and try to find where that pivot point is.
That's amazing, actually, because I've been doing a lot of obviously pre-market prep videos with like live streaming and stuff like that, and the first thing I do after I analyze the Nasdaq and the S&P is obviously go and find those support resistance levels on a certain asset, right? The hot stocks that gapping up or down, right? So if you will give our traders that, and they will know exactly that this is a great level of supply, demand, resistance, support area, that automatically gives them the chance to focus on executing the trade around that level instead of looking for that level by themselves and maybe missing that, right?
Yeah, and I'll give you some insight. So dating back, we're one of the oldest, if not the oldest proactive newsletter on the market right now. But dating back to the peak of the internet bubble, when we did all of this stuff, this was before index ETFs existed. And it was obvious to us back then that market correlation mattered. You need to understand where the stock market was going, because a rising tide lifts all boats and vice versa. It's just this matter of fact. Now, with that said, back then when index ETFs didn't exist, we needed to find stocks that correlated with the market. And so we developed, and we still use today, a stock correlation tool, which will filter out the stocks that are not likely to correlate with the market and pinpoint the ones that are. And with that, provide trading plans for the end user for those particular stocks that, one might look better than the other, but they'll have a a number of trading plans for a number of different stocks that they can select that are likely to correlate with the market. And so stock correlation absolutely matters. We used that formula to achieve between 2000 and 2002, 550% return while the stock market plummeted. And so the proactive rules-based approach works, and it can empower the competitive advantage of an individual investor. They have far greater competitive advantages than institutional investors do because you're able to manage risk, right? That's where it all boils down, right? If you're not managing risk, you're doing yourself a disservice, because that's the competitive advantage of the active trader. It's all about managing risk. Even if you're stopped once or stopped twice, if you're maintaining a discipline and you're identifying these pivot points, you're going to hit a good deal of them as well, right? So risk control is the main component here.
100%. I mean, I just traded today NVIDIA and AAP, and definitely if I didn't have that risk control, I would probably lose on those two trades. So, but just to get back to what you said before, so basically your AI takes into consideration the market levels and also the specific asset, the specific stock, for example, levels, and combine them in order to find the right supply or demand area. So yeah, if I'm getting it right, so your AI, your algos understand.
The market analysis is conducted separately. It's not, and then when you find the pivot points in the market, you can use index ETFs or other instruments to trade the indexes, of course, or you can correlate, right? And so the idea is to correlate at the time that, let's say, is support levels tested in the S&P 500. You could go and correlate to find stocks that are doing the same thing if you did not want to use the index ETF. Now, my personal opinion is we developed the correlation tool because there weren't index ETFs available at the time.
Right.
The liquidity from SPY or QQQ is tremendous. And so my personal point of view is I like those index ETFs because it removes that second step. But that second step is highly actionable as well. And instead of trading one index ETF, you could trade 5 or 6 stocks at the same time.
True. Yeah. So can you give us like insight or a top secret of how exactly it works, or does it go, your AIs or the algos goes and find gaps in the market, gaps in the stock, in the specific stock, or just scan it throughout history and find where liquidity was? Oh, exactly. I'm just, as a trader,
I'll give you an example of one of our strategies. But by the way, our clients tend to use our strategies as strategy indicators as well.
Okay.
And so I'm not suggesting that these strategies need to be used, but to answer your question, I'll use a rules formula from one of our strategies. And that rules formula takes the NASDAQ 100 and identify, we have the predefined support and resistance levels for the NASDAQ 100.
Right.
When support levels are tested, but by the way, it's important never to trade in the middle of a channel. I think that's a basic rule of technical analysis. You always want to do it near a pivot point.
Yeah.
If the NASDAQ 100 is near a pivot point, and the rule for that trigger is 3 points, so it needs to come within 3 points of that trigger point, then we buy QLD in that strategy. And if it breaks that pivot point by a fraction, so that's a 0-point rule. The first rule was a 3-point rule. The second one is a 0-point rule. Breaks by a fraction. We sell the QLD position and essentially go back to a neutral position and wait for the market to move 5 points one way or 5 points the other. If it moves 5 points up, we buy QLD again. If it moves 5 points down, we buy the inverse or the QID position in that strategy. That's the 5-point rule. So we have 3, 0, 5. And then the stop loss for the second one is a 1-point rule. So if it breaks 1 point in the opposite direction, we sell whatever position that is. So that's an example of rules-based, right? And we run through these type of algorithms and these type of formulas in our back end to provide what are the optimal entry and exit levels given what would be rules-based formulas like that.
Nice. So you've been in the market for a while now, right? So let me ask you this. A lot of the guys, Twitter or whatever it is, talking about the market changing, right? The conditions are changing and stuff like that. And since you saw a lot of movement in the market and you have those algos, how different you analyze and find those pivot points or the support and resistance levels from what you did 10 or 15 or 20 years ago? Is it really changing on your side?
The market changes all the time, but not necessarily in the way that people think. The difference between the type of most effective trading plans or most effective pivot points is really based on volatility levels. Mm-hmm. When volatility is higher, the spreads widen. And when volatility lessens, the spreads come down, right? And that changes opportunity too, right? So it changes risk and it also changes opportunity. But those volatility levels will change from time to time depending on what's going on in the market every single year, right? Now, granted, if you have a 2017-like condition where stimulus monies are coming in every single day and there's absolutely no volatility, that's a really difficult market to trade intraday in, right? Whereas, a market like last year where there's activity going on left and right, the spreads are much wider and it's much nicer for active traders. And so the difference that I find is not a broad difference in what's going on in the market, but instead it's a difference that happens regularly where volatility levels change. And it's up to us and up to traders in general, right, to identify those changes in volatility, because those changes in volatility will tell you how to manage risk and what to expect from return as well.
Yeah. So going back to the pivot points and the levels that your algo, the AI is finding on a regular basis, is it, there are sometimes, we had it in NVIDIA again a few days ago after the earnings, there are times when a level will automatically breach as soon as we get in a lot of liquidity and a lot of momentum to that trade, right? So let's say I have a resistance level at 200, but if the momentum is coming in hard, it will break through it easily. Does your algo and AI take that into account as well? Understanding that sometimes, the momentum is just pushing super hard and the resistance or support won't help?
Well, ours is price-based. And so the price will tell us what's going on with respect to the stock. By the way, NVIDIA, I think, broke our resistance level near 326, right? And so it broke well before this recent rally. But the price action in the stock is going to tell you what to do and how to control risk. I can say this, if there is a gap up, like you just described, and a resistance level has broken, but the stock is not close enough, or the index ETF or the index itself is not close enough to establish a trigger, we won't trigger it, even if there is momentum. And that's because if we do that in the middle of a trading channel, it increases our risk threshold. And our risk threshold, it's important if we're going to adhere to risk controls and accept stop losses that we keep them to a minimum, right? And so if we increase our risk threshold, it then increases, let's call it emotion, and it removes the discipline that's necessary. So with a price-based approach, we always want to do it close to the pivot point, regardless of a gap up or not, right? Yeah. And so if it revert back, then we would trigger the trade in essence.
Okay, so I guess my last question would be, is it at those levels, right? Do you have them just a pre-market? So I'm getting the levels pre-market, but
fantastic question.
Yeah.
This is one of the most important things that Stock Traders Daily does. Stock Traders Daily provides all of this data about 30 minutes after the market closes each day for the next day.
Wow.
In other words, we're preparing our traders and our subscribers, we're preparing them in advance all the time so that they're ready. They don't need an alert. They don't need to look at an email. They don't need to question where the data is, because the data is there for them the night before. Now,
Right.
depending on where the market opens and where the stocks open, they might open above or below a respective pivot point. So you have to then apply the rules of the technical analysis to where that opens. But those pivot points are always provided in advance, purposefully, because you need to be prepared as an investor, as a trader.
Yeah, that's 100% right. So amazing. I mean, our traders probably going to love this. And again, we use scanners. We have a trading journal, Bookmap, Trade Ideas, other companies that we're working with. And I'm sure they're going to love your market research as well and use it on a daily basis, especially for those day traders. And yeah, so I wish both of us and the traders a lot of success in this.
Me too. I do.
All righty. So for those of you guys who want to join and basically get it for 30 days free, just sign up for Trader Pool, and you will automatically, within up to 48 hours top, get your user, and you can start using it in order to start seeing levels and stuff that you will probably won't see by yourself. So that's a huge benefit for you. All righty. Take care and good luck, guys.